Today, we are cracking the code to building real sustainable wealth. And I'm not talking about luck or some get-rich-quick scheme. I'm talking about a clear, repeatable system. We're going to walk through exactly what that system looks like, step by step.
So let's just jump right in with a question that trips a lot of people up. You probably know someone, maybe a doctor, a lawyer, a top salesperson, who makes a fantastic salary, but they just never seem to get ahead. They're kind of stuck on this financial hamster wheel. So what gives?
And the answer, really, it boils down to this. It's a huge mindset shift. See, wealth isn't really built by just trading your time for a bigger and bigger paycheck. It's built by acquiring assets that work for you even when you're not. It's about owning things, businesses, real estate, stocks. And to pull that off, you need a framework, a repeatable system.
And that framework is what we're going to call the wealth operating system. Honestly, you can think of it like the operating system on your computer or your phone. It's the program running in the background designed to guide your finances from wherever you are today to exactly where you want to be.
This whole system breaks down into 4 pretty distinct phases. First, we've got to build a rock-solid foundation. Then, and only then, do we ignite the growth engine. After that's running, we optimize it for maximum power. And finally, we build a fortress to protect everything you've worked for. So let's dive into Phase 1. Phase 1 is all about playing financial defense. You just can't build a skyscraper on a shaky foundation, right? It's the exact same idea with your wealth. This is where we pour the concrete and make absolutely sure your financial house is in order before we do anything else. Okay, so the steps you see here might look kind of basic, but listen, they are non-negotiable. Before you even think about buying a stock or a piece of real estate, your entire focus has to be on maxing out your main income, knowing where every dollar is going, and spending less than you make. It's that gap, that surplus that becomes the fuel to build up a 3 to 6 month cash cushion and, maybe most importantly, to go to war with any high-interest debt that is actively eating you alive. And this is such a critical distinction to make. Not all debt is your enemy. In fact, some of it can be your best friend. Good debt is a tool. It's leverage that you use to buy assets that go up in value, like a business or a rental property. But bad debt, man, bad debt is a wealth killer. Think credit card debt with those insane interest rates. It just finances stuff that loses value and it makes you poorer with every single payment. Phase 1 is about wiping out the bad, so you have the freedom to use the good later on. Okay, so once that foundation is solid as a rock, now we can flip the switch. We can go from playing defense to playing offense. Phase 2 is where the real fun starts, where wealth creation actually happens. It's the big leap from simply saving money to strategically owning assets. But you might be thinking, why own assets? Why not just stack up a huge pile of cash? Well, the answer is one word: inflation. It is the silent killer of wealth. Every single year, the cash in your bank account buys a little bit less than it did the year before. Just letting it sit there is like parking your car in a river. The current is just slowly but surely pulling you downstream. Your money has to be growing faster than inflation just to break even. So, how do you actually do that? Here's a super simple but really powerful model to follow. Try to live on about 50% of your income. But the most important part is this next slice. 25% is non-negotiable. That money is dedicated, no exceptions, to growth, to buying assets. The last 25% is kind of flexible. You can use it for lifestyle upgrades or even better, use it to crush any leftover debt from Phase 1. So where does that 25% for growth actually go? Well, for most people, the growth engine is powered by 2 main asset classes. You've got stocks, especially simple, low-cost index funds that just track the whole market, like the S&P 500. They're easy to get into and have a great track record. Then you have real estate, which offers a totally different set of advantages. You can use the bank's money to control a huge asset. You get amazing tax breaks, and it can spit out consistent cash flow every month. A really powerful growth engine is going to have a mix of both. Okay,
Now, once that growth engine is humming along and you're consistently buying assets every month, we enter phase 3. This is where we get advanced. It's all about making that engine run way faster and way more efficiently by legally minimizing the single biggest drag on your growth: taxes.
This right here, this should really stop you in your tracks. For real. Think about it. Over your entire life, there's a good chance you'll pay more in taxes than you will for your house, your car, and your kids' education combined. So reducing that bill by even a few percentage points can free up hundreds of thousands or even millions of extra dollars for your growth engine over time. It's a huge deal.
So let's look at one of the biggest tax hacks out there for small business owners. If your business is netting over, say, 50 grand a year, you absolutely need to know about the S-Corp election. It's basically a way to tell the IRS to look at your business income differently, and it can save you an absolute fortune. So here's the magic behind how it works. As an S-Corp, you split your income into 2 buckets. First, you pay yourself a reasonable salary, and that gets hit with the full 15.3% self-employment tax. But, and here's the key, all the profit your business makes above that salary, you take it as a distribution, which is not subject to that 15.3% tax. For a business clearing 6 figures, this one move can easily save you over $10,000 a year every single year. Now, for the real estate investors out there, there's this massive tax benefit with real estate, but there's a big wall the IRS puts up that usually stops high earners from using it. It's called the passive activity loss rule. And it basically says you can't use your rental property losses to lower the taxes on your main income from your day job. But there's a key to unlock a giant loophole around that wall. And this is the key: 7 days. That's it. If the average stay for a guest in your rental property is 7 days or less, the IRS changes its mind. It doesn't see it as a passive rental anymore. Suddenly, it sees it as an active business, almost like a hotel. And that one little change, it changes everything. So here's the full playbook. You buy a property and you run it as a short-term rental. You're involved in managing it for at least 100 hours a year. Then you do something called a cost segregation study, which lets you create a massive paper loss from depreciation in the very first year. And because it's now legally an active business, you can take that giant paper loss and use it to directly slash the taxable income from your high-paying day job. It is, without a doubt, one of the most powerful tax strategies in the entire tax code. And that brings us to the final phase, phase 4. Look, once you've successfully built a significant amount of wealth, the game totally changes. The goal isn't just about growth anymore. The new priority is preservation. It's about building a fortress around your wealth to protect it for you, your family, and for generations to come. So when does this phase really kick in? Well, a good rule of thumb from experts is when your net worth starts to cross that $1.5 million mark. It's at this point that the risk of losing what you have, to a lawsuit, to a bad business deal, becomes a much more serious threat. You have to get strategic about how your assets are organized. A really simple but incredibly powerful way to visualize this protective structure is something called the T formation. Just picture a big letter T. The vertical base of the T is your trust. That's for your estate planning. The left arm of the T holds your active operational businesses, and the right arm holds your safe, passive assets. The genius of this setup is all about building firewalls. Think about it. Your active businesses, the ones where you're actually doing stuff, carry the most risk of getting sued, so they live over on the left side, each in their own separate LLC. Your safe, passive assets, like your rental properties, they live over on the right side, also in their own separate LLCs. So if your business on the left side ever gets into trouble, the assets on the right side are completely walled off and protected. It's all about separating risk. So, there you have it. That's the full operating system. It's a 4-phase journey that guides you from just getting your financial feet under you to igniting real growth with assets, then to turbocharging the whole system with smart tax strategy, and finally, to locking it all down inside a legal fortress. And that leaves us with one last question. Is following this code really just about getting a bigger number in your bank account? Or is it about something more? Is it about engineering a system that gives you real freedom, security, and the power to choose how you spend your time and live your life? Because at the end of the day, that's what true wealth is all about.